Welcome back to Future Drive, the channel where cars meet money, technology, and the future of driving. Today we re-diving into a crisis that's hitting car buyers everywhere in 2025. Underwater car loans. What does that mean? Why is it at a 4-year high? And most importantly, what should you do if you're stuck in the same situation? Stick around, because I'll break it all down with the latest data, real examples, and smart tips to protect your wallet. First things first. What does underwater or upside down on your loan actually mean? It's when you owe more on your auto loan than your car is worth. For example, if you still owe $30,000 on your loan, but your car's actual market value is only $23,000, you're $7,000 underwater. This becomes a huge problem when you try to trade in your car or buy a new one, because that extra debt doesn't magically disappear. You either pay it out of pocket or roll it into your next loan. Here's the shocking data. In the second quarter of 2025, 26.6% of trade-ins had negative equity. That's up from 26.1% in Q1, and the highest level since 2021. Back then, nearly 32% of trade-ins were underwater. The average amount of negative equity in 2025 is about $6,154 per vehicle. Even worse, many people are underwater by much higher amounts, close to $10,000 or more on larger vehicles. These numbers show that more than 1 in 4 people trading in their cars is starting off in the red. There are a few key reasons. Car depreciation. Cars lose value fast. The moment you drive off the lot, your new car drops in value, sometimes by 10% or more. Long loan terms. Buyers are now stretching loans out for 72 months and even 84 months. In Q2 2025, 21.6% of new auto loans were 84 months long, up from 19% earlier. Compare that to 72-month loans, which are still the most common at around 36%. Small down payments. Many buyers put little or nothing down, meaning they start their loan with very little equity. High interest rates. With borrowing costs higher in 2025, loan balances shrink slowly while car values fall quickly. Together, these factors trap buyers in loans that outlast the value of their vehicles. So, what does this mean if you're trying to buy a new car? If you trade in an underwater car, you must pay the difference in cash. Most people can't afford that, so they roll the debt into a new loan. Example: you owe $7,000 more than your car is worth, and you buy a $35,000 SUV. This is how people get stuck in a cycle of debt, always paying more than their car is worth. It's not just trade-ins. If your car gets totaled in an accident, insurance might only pay the car's actual cash value, not what you owe. That leaves you on the hook for the balance. Here are some practical steps you can take. Hold on to your car longer. Driving your car a few more years can give your loan balance time to catch up with depreciation. Make bigger down payments. Even 15 to 20% down can dramatically reduce your risk of going underwater. Avoid 84-month loans. The payments look small, but the long term almost guarantees negative equity. Get gap insurance. Gap insurance covers the difference between what your car is worth and what you owe if it's totaled. The good news: it only costs around $20 extra per year on top of regular insurance. Improve your credit score. Higher credit, shallers better loan rates, shouted faster equity buildup. Shop around for financing. Get pre-approved by multiple lenders before going to the dealership. It gives you leverage and helps you avoid bad deals. But what if you're already upside down on your loan in 2025? Refinance into a lower interest loan if possible. If you absolutely need a new car, look at cheaper models to keep your debt manageable. Don't be afraid to walk away from dealer offers if they try to roll your negative equity into a high-interest loan. At the end of the day, being underwater on a car loan is becoming more common in 2025. But you don't have to fall into the trap. Understand how loans work, protect yourself with gap insurance, and make smarter decisions about down payments and loan terms. So tell me, Have you ever been underwater on a car loan? And do you think lenders are pushing buyers into debt with these long-term loans? Drop your thoughts in the comments below. And if this video helped you, don't forget to like, subscribe, and share Future Drive. Because here, we don't just talk about cars, we talk about the money, technology, and future trends that shape your drive.